Actually, let me go ahead and get started while a few of you are finished wrapping up. So we just saw 8 pitches, right? What are some common mistakes that you see entrepreneurs make, not just today, but in general when you get pitches from early stage investors? Excuse me, early stage entrepreneurs. What are some common mistakes you see?
Not enough barriers to entry. Companies that get started, sometimes it's just a start of passion and they haven't really thought through that there are 50 other companies doing the same thing. And then it's not necessarily a mistake, but it's thinking through your business model, how you're going to make money and all that. But also, are you, over time, going to build a network that's stronger than any of the existing competitors in that field? Are you going to link together all your customers? Are they somehow going to spread quickly? Are they, or if it's enterprise, is it mission critical? Is it something that once the customer uses it, they are never going to quit? They're stuck.
Maybe I can add to that. First of all, I think all 8 startups deserve a lot of credit. It's very diverse. I might have counted wrong. I was also very impressed that I think half of it were female CEOs. It is definitely getting more diverse. I would say there are 2 key things, and it's not necessarily mistakes. It would be ideal to see that. One is, what is the unique insight? Like, a lot of the most successful companies are successful because they get one thing very right. And a lot of times these decks and these presentations and pitches start getting into this is a $1 billion market, blah, blah, blah. But you can't really capture or understand the unique product insight. The second thing is what we kind of like call reverse engineering success. I think some of the best founders that we meet, they not only tell you the story now, but what the company is going to be 3-5 years from now, and they say, you know, this is why we're going to succeed. You know, we can have 10,000 customers at $10,000 a month. We already have 1,000, and here's our unit economics, and here's why we're going to succeed. So a lot of these focused on just the potential or the benefit, or if everything works all right, how they're going to get to like 80% market share. But I don't think it was as realistic or like we quite understood the mechanism of getting there. And I think stressing that would be very helpful.
Yeah, I think to add on to those 2 points, I think people fail to explain why their company is going to be special or different. The idea is probably not that new. So how you're going to be different from everybody else, sometimes it's about barriers to entry, sometimes it's about differentiation, sometimes about your brand. Sometimes it's just the unique insight that you have. But often people don't even figure out that what's special about their company and why time or history is going to treat them differently today.
Okay, any others? All right, let's talk about cross-border investing. I know many of you do a lot of international investments, and some of you might say here closer to home. But of course, 65% of venture capital is generally deployed right here in Silicon Valley, or at least in the United States. Do you think that that a lot of investors are missing opportunities internationally? And what specific geographies might you want to highlight to other investors?
Well, I think a lot of my colleagues here invest internationally. So at Sequoia, we have a global sort of platform. We started investing in India, China, Israel probably more than a decade ago, before I even joined the firm. And there's a firm belief that ideas can be born anywhere, especially in a world where globalization is happening at the pace that it's happening, and the internet and mobile kind of sort of makes everything sort of flat. The world is very, very flat. And so we have offices in the US and Israel and China and in India, and our model is not to do cross-border. We don't fly back and forth. Our model is that everybody who invests in those geos are local to that geo, understands the ecosystem in those geos, and can partner with entrepreneurs and be their partner as opposed to just being an investor.
So maybe I can add 2 very quick insights, referring to the previous comment I made. I think a lot of times cross-border investing, there is a misconception that it's all about investing in a specific geography. I think we've done really well. Our first IPO was Canadian, Shopify, and it's because we basically look for the most interesting markets and problems to be solved, And if the company solving them is outside of Silicon Valley, we invest, but we don't say we're going to go invest in Canada, whatever. It's just like one of the most popular companies we like happened to be in Canada, and it was in Ottawa. Wasn't even in a popular city within Canada. I think the second thing is there is a benefit and there is a pro and a con of investing internationally where Silicon Valley has such huge dense talent that you have a lot more density of great startups here. But on the other hand, because of that, there is huge competition and the cost factor is really high. So we have this like 80-20 balance right now where 20% of our portfolio is international. The 20% has no recruiting problems and their cost is about 20% of Silicon Valley. But on the other hand, you have much higher density of successful startups. So we feel that that's a very good balance and it creates kind of a very good model for our portfolio.
We started a long time ago, and what's interesting is that there are certain things that were working then that probably aren't going to work now. Fast followers, Me Too's, were actually a good way to work for many years, and now the technologies blend together very quickly. If something happens here in the U.S., it'll be weeks before somebody in China has started a competitor, and it'll be, maybe a month before even somebody in Africa sees it. The fact that information spreads so fast, communications move so fast, it means that there's a real premium for creativity, and there's a real premium for innovation for being first. Because if you are first and you've figured out the model and you've grown your own base quickly, it will spread around the world faster than ever before. So we're now cognizant of that and really looking for the best new businesses wherever they are. And so we use the Draper Venture Network to tap into all the different sources all around the world. And then, at least for Draper Associates, we'll just invest in the best. But I got to say something about governance. Governments. Some governments are very aggressively competing for you, for the entrepreneurs and the capital of the world. And they, for instance, Estonia is now doing this whole virtual governments thing. And it's going to be so much easier to do business in Estonia than, say, I don't know, name another country that's maybe really like the government's heavy-handed, or a bad dictatorship, or a number of other things. So we're seeing the governments improve just because they need to attract the entrepreneurs, the businesses, the capital of the world. So there's a lot of interesting things happening in governance. And if you invest in other countries, it's a little buyer beware. In Silicon Valley, you pretty much know what the drill is, and so do all the lawyers and everybody else. You go to another country, every time I go to another country, I discover more things that I didn't know on the surface, but somehow we've been able to do very well. In fact, our 10% of our money was invested outside of the U.S. and 90% inside. This was maybe, I guess we calculated about 5 years ago. And 90% of our returns were from outside the U.S. and 10% of our returns for inside the U.S. So I don't think it'll continue that way, but it was good to be a pioneer.
I think for the last 20 plus years, having the localized funds make more sense. As innovation happens in the U.S., whoever can copy it fast, clone fast, localize fast will end up winning. So having a localized approach kind of makes sense. Part of our thesis is that over the next 10 years, cross-border will be huge. And when we said that 3 years ago, most people laughed. But seeing companies like Wish and Musical.ly happen, it's mind-boggling. And to be able to make decisions very quickly on companies like Wish, which we're both in, or Musical.ly, you need to have that cross-border perspective. As China accounts most of the manufacturing in the world, despite some of the trends shifting, and you see China being innovator on a lot of consumer internet models like WeChat, what WeChat is doing. You look at the stuff that's happening on Snapchat, some of that are inspired by WeChat or by KakaoTalk or Line. So the ideas are becoming more global.
Yep.
Talent will become more global. So if you have a team that know how to leverage resources and their lessons from multiple geographies, they're more likely over the next 10 years to build global companies. And VCs need to do the same to be able to recognize that pattern much quicker, sooner. So our hope is that in the next 10 years, the cross-border model will win out, and we'll see.
I mean, I think this panel is probably in violent agreement that cross-border is something that everybody, all of us are investing in. I mean, certainly for 500, from day one, we've been pretty vocal about that we do want to invest not just Silicon Valley, but overseas. And kind of like what you said, 3 years ago, people kind of raised their eyebrows. Same for us. Early on, it was actually, I think, a reason people used to kind of doubt us and our strategy, saying, well, 500 does a lot of international companies. But it's funny now, with a lot of the reasons that everyone on the panel has brought up in terms of companies being a lot more global, distribution platforms, like messaging and even Facebook, all of this stuff, like things, just the world feels a lot smaller than it ever did. Even 6 years ago, it's even just a short amount of time. So we see things happening like unicorns like Grab in Southeast Asia or in other markets that 6 years ago we probably wouldn't have seen. And so of course because of that, we personally feel very good about continuing to be investing cross-border, even to the point where we're it's a pretty big kind of thesis we're embarking on in terms of microfund strategies. So like actually setting up local funds in different regions. Somewhat similar to how DFJ has been doing kind of these localized funds in different markets as well, right? So, but I feel like if you are not at least even considering or starting to put money into non-Silicon Valley companies, you're going to be behind.
Great.
So, we're invested in both Grab and DD. So in 10 years ago, if you meet a company like Grab, you're a Southeast Asian fund, you just invest in the company and, see if the company can succeed on their own. For us, we actively recruit DD to meet with Grab, share lessons, Grab go visit DD headquarters, see how DD competes against Uber, and actively try to recruit talent from China to join them in Southeast Asia, or local Chinese talent to join Grab. So it's a lot of sharing and learning goes on. So unless you have one fund that wants to do that, it's harder. But again, go back to the question that we asked Scoutable before. Any team has to execute a strategy that fits their strength and their personality. It's anybody trying to execute on a strategy that doesn't fit what they're good at is not going to win. And even if you stay the same way of investing 10, 20 years ago, if you're really good at what you do, you're still going to be fine. So it still comes down to execution.
All right. We have just a little time left, so we should definitely get to the impending doom part of the panel. So let's talk about that a little bit. Every other month, right, there's another article written declaring impending doom. The bubble is upon us, right? And there are some numbers that could justify this right now, right? The number of deals are definitely down. I think it's 26% year over year, the number of deals, while the amount of funding is slightly up, but that's mainly from a lot of later stage large deals. At the same time, there's a lot of uncertainty in the marketplaces. There's the presidential election, there's the existence of Donald Trump, there's Brexit, there's relatively few tech IPOs. Okay, so you can say there's some uncertainty in the marketplace right now, right? So what do you guys see, what do you all see for the next 6 months? Are the calls for a bubble still overstated, and so on?
I just want to rattle a couple quick stats. I think for our last annual meeting, we did an analysis that in the last 10, 15 years, the market cap of the top 10 internet companies alone has grown from less than 100 billion to I think multiple trillion. So I think there was so much focus on what happens every quarter and things that people can't control, and every little deviation in the curve where it's doom, no, it's whatever, everything is going to be incredible. But I think the value creation that technology is doing is accelerating. So I think these companies, when you look at the largest tech company 10 years ago versus where those are now, and the new ones like Uber, they're getting 10, sometimes 100 times bigger. I think the other thing that's happening, which is good for entrepreneurship, but sometimes risky for investors, is that let's say that the very best companies have doubled, but the number of startups have gone by like 100 to 1000x, which is great. We want to foster entrepreneurship, but it means now that to find that needle in the haystack has gotten much, much more difficult. And then the last thing, there is, I think, a confusion of like, when we are talking about things like Doom, the internal value of the companies don't change. The thing that changes is based on what's happening in the market and people's emotional reaction. The premium that gets put on that changes, that multiple changes. And people confuse that multiple with the actual value of the companies. But when you look at the underlying fundamentals of those companies and you have more of a 5 or 10-year period, that value is increasing and it's accelerating to increase. But obviously, like if we have some crazy presidential election or something really terrible happens or war breaks out, you can't predict that. But everything else being equal, if we don't screw this world up, I think there's a lot more great things that are coming our way.
I agree with Aydin on a lot of his comments. I would also just point out that there's way more bifurcation in the market than before. So yes, there's a large market cap created, and yes, the funding actually in dollars went up, but the volume went down. In the private markets, you have the mega companies like Uber, Airbnb, Pinterest, and then you have a bunch of companies that are having a hard time getting investment. That is, the same is true in the public markets. The market cap creation is very much attributed to 4 companies. They're called FANG. And then there's a bunch of like smaller internet IPOs that happen that nobody's that excited about, which is why the IPO market is mostly closed. And so I think if you don't like uncertainty, we're entering a world with slightly more uncertainty. But if you don't like uncertainty in the first place, you shouldn't be an entrepreneur. You're going to have to deal with more uncertainty as the world goes by. I think the number of seed companies that are started is high. That means that a lot of ideas are going to get started, and we're going to churn through them more quickly, which means there's going to be more innovation. You might have to do the sort of terms like pre-seed, soil, seed extension. Those terms were not part of the vernacular when I started as an entrepreneur. It's very popular now. But that just means that you have more shots on goal to sort of get your company to hopefully the high terminal value that you want as an outcome.
So the good news is you guys are still asking questions about the bubble, because as long as people are talking about a bubble, you're not anywhere near them. The bubbles are when you get blindsided. When the press is all thinking that the world is all rainbows and butterflies, and then boom. So I think we're good for quite a few years.
I think some of this also depends on, for folks on the panel. I mean, I can speak for us personally. Like, we haven't changed anything about what we're doing. We haven't decreased the number of deals we're doing. That said, I have talked to some, say, Series A firms who shall remain unnamed, but they've actually said, a couple of them, we're doing about half the volume we are, and these are like Sand Hill, like reputable firms. But I think it really depends on what stage you're talking about. Most likely at the early stage, at least if you're investing at the pre-A level we are at. Companies, it's always hard to raise money if they talk about like, oh, I couldn't raise my round. I mean, there could be a lot of reasons why. It's always going to be harder and harder to raise a round. Of course, if you're on the other end of the market, like really late stage, you might feel it more. So I think, but everything affects, even stuff that happens way, in the late stages is going to affect everything. So of course, everyone's just sort of watching. I personally feel like it's just a lot of hogwash a bit, but it's it's just something to keep an eye on. I think it's just more that there was a lot of excitement and froth, in the last year, and it's probably more cooling off. But I think if you look at kind of what Aydin mentioned, like look at the companies that have performed, like they're performing like amazingly, right? It's just maybe things have been the froth is cooling off a bit, but it's not going to burst.
When GGV invested in Alibaba in 2003. E-commerce's percentage of retail in China was less than 0.1%. Valuation was a whopping $170 million as a B2B listing service. Fast forward today, e-commerce as a percentage of retail in China is 17%, probably one of the highest, if not the highest in the world. And Alibaba market cap is $200 billion. So over 1,000x in 12 years. When we look at the underlying trend, the world's going from 2 billion smartphones, 3 billion IoT devices to potentially double that with 3G and 4G coming to allow a lot more people to spend time on smartphone with broadband services, doing a lot more than just reading news. So when that happened, what we saw in China over the last 10 years is that just the total spending and time spent online made it possible to build much bigger businesses. So I think I will argue that over the next 10 years, any company that can globalize at a faster pace, I mean, Airbnb without Europe may not be Airbnb the way it is today. Companies that can globalize at a faster pace are going to break out sooner and therefore get funding faster than the competitor. So in the longer run, you're more likely to succeed if you can globalize at an earlier pace. So I think the next 10 years could be even more exciting than what we have seen.
Great. All right. No reason to worry. All confidence from the panel. But thank you all so much for being on the panel and judging our startups today. We really appreciate it. If you'll stay here and help us to congratulate the winners. I believe Ryan is bringing the results now.